You know what's interesting? When the US Mint puts American Silver Eagles on a 3-month backorder, most people think it's just a supply chain issue. A little hiccup, nothing to worry about. But here's what they're not telling you. This isn't the first time this has happened. And every single time it does, the same pattern emerges. The waitlists grow, the premiums explode, and by the time the general public realizes what's happening, the opportunity is already gone. Let me walk you through what's really going on right now, because this 3-month backorder, it's just the visible symptom of something much bigger happening beneath the surface. The US Mint produces American Silver Eagles at the West Point facility in New York. They've been doing it since 1986. For nearly 4 decades, these coins have been the most trusted, most liquid form of physical silver in the world. When you want to own silver, you buy Eagles. That's just how it works. Oh, but here's the thing about the Mint. They don't produce these coins based on what they think demand will be. They produce them based on orders from authorized dealers. And right now, those dealers are placing orders that the Mint physically cannot fulfill for 3 months. Think about that for a second. The United States Mint, with all its resources, all its capacity, cannot keep up with demand for silver coins. Not for a week, not for a month, for 3 full months. Now, I've been watching precious metals markets for years, and I can tell you exactly what this means. When the Mint goes on backorder, it's because something fundamental has shifted in the market. It's because demand has spiked so dramatically that even ramped-up production can't match it. And here's where it gets really interesting. This isn't happening in isolation. While American Silver Eagles are on backorder, look at what's happening with other silver products. Canadian Maple Leafs? Delayed. Austrian Philharmonics? Limited availability. Even generic silver rounds from private mints are seeing delivery times stretch from days to weeks. The entire physical silver market is experiencing a squeeze, and most people have no idea it's even happening. Let me tell you about what happened in early 2021. You might remember the Reddit silver squeeze movement. Retail investors, frustrated with what they saw as manipulation in the silver market, decided to buy physical silver en masse. Within days, dealers were cleaned out. Premiums on Silver Eagles shot from $3 over spot to $10, then $12, then $15 over spot. The US Mint went on allocation. They could only fulfill a fraction of dealer orders. And here's the kicker. Spot price barely moved. Silver went from $25 to $30, then fell back down. But if you wanted to actually buy physical silver, you were paying $40 an ounce or more. That's the disconnect between paper silver and physical silver. And it's happening again right now. See, when you look at the silver price on your screen, you're looking at the COMEX futures price. That's paper silver. Contracts that represent silver but aren't actually silver. It's a derivatives market where banks and hedge funds trade massive positions without ever touching a single ounce of metal. But physical silver? That's different. That's real metal that has to be mined, refined, minted, and delivered. And when demand for physical exceeds supply, you get what we're seeing right now. Back orders, waitlists, premiums that keep climbing even when the spot price stays flat. Now, let me show you why this is happening right now specifically. First, look at industrial demand. Silver isn't just a precious metal, it's the most conductive element on Earth. Every solar panel uses about 1 ounce of silver. Every electric vehicle uses 2 to 3 times more silver than a traditional car. 5G infrastructure, medical devices, water purification systems, they all require silver. The Silver Institute just released their 2024 World Silver Survey. Industrial demand hit a record 690 million ounces. That's up 9% from the previous year. And here's the problem. Total mine supply was only 830 million ounces. When you add in investment demand, jewelry demand, and silverware, you're looking at a deficit of over 200 million ounces. That deficit has to come from somewhere. And it's coming from above-ground stockpiles that are rapidly depleting. But industrial demand is just one piece of the puzzle. The second factor is what central banks are doing. Now, central banks don't typically buy silver the way they buy gold, but what they are doing is buying gold at a record pace, and that's creating a spillover effect into silver. In 2024, central banks added over 1,000 tons of gold to their reserves. That's the second highest year on record. China, Russia, India, Turkey, Poland, they're all accumulating. And when central banks buy gold, it sends a signal to investors worldwide. Precious metals are a safe haven. That signal is driving retail investors into both gold and silver. But here's the thing about silver. It's more accessible. Gold is $2,650 an ounce right now. That's a significant barrier for average investors. But silver at $31 an ounce? That's manageable. You can buy a tube of 20 silver eagles for around $800. So you're seeing this massive wave of retail demand hitting the silver market, and the US Mint can't keep up. Third factor, geopolitical instability. Every time there's a crisis, precious metals spike. We saw it with COVID. We saw it with the Ukraine invasion. We're seeing it now with escalating tensions in the Middle East, the ongoing trade war rhetoric, and concerns about the US debt ceiling. When people get nervous about the future, they buy tangible assets. And silver is one of the most tangible assets you can own. But here's what most people miss. They think these back orders are temporary. They think, okay, I'll just wait 3 months and buy then. That's not how this works. Let me tell you what happened in 2008. When Lehman Brothers collapsed and the financial crisis hit, silver demand exploded. The US Mint couldn't keep up. They went on allocation, just like now. Dealers had wait lists, just like now. And you know what happened to people who waited? By the time the Mint caught up with production 6 months later, the spot price of silver had already doubled. People who waited to buy at $12 an ounce ended up paying $24 an ounce. The back order isn't the problem. The back order is the warning sign. Now I want to talk about something that doesn't get enough attention: the COMEX silver inventories. The COMEX is where the paper silver market operates. It's where futures contracts are traded, and they're supposed to have physical silver backing those contracts. But here's the interesting part. COMEX registered silver, that's the silver available for immediate delivery, has been declining steadily. In 2020, COMEX had about 180 million ounces of registered silver. Today, it's around 50 million ounces. That's a 72% decline in available silver for delivery. Meanwhile, open interest in silver futures has remained high. That means there are a lot of paper claims on a shrinking pool of physical metal. This is what's called a squeeze setup. When you have more claims than metal and demand keeps rising, something has to give. Either the price spikes dramatically or the system breaks. And we're starting to see cracks. In March 2023, there was a delivery default on the COMEX. A major bank couldn't deliver the physical silver they were contractually obligated to provide. They had to settle in cash instead. The mainstream media barely covered it. But in the precious metals community, it was a huge red flag. Because if the COMEX can't deliver physical silver, what does that say about the integrity of the paper market? Here's another angle most people don't consider: the gold to silver ratio. Right now, gold is trading at about $2,650 an ounce. Silver is at $31. That's a ratio of about 85 to 1, meaning it takes 85 ounces of silver to buy 1 ounce of gold. Historically, that ratio has averaged around 60 to 1. In ancient Rome, it was 12 to 1. Even in modern times, during periods of market stability, it tends to hover between 50 and 70 to 1. At 85 to 1, silver is historically undervalued relative to gold. And when that ratio compresses, when silver catches up, the moves can be explosive. In 2011, when silver hit its all-time high of $49 an ounce, the gold to silver ratio dropped to 31 to 1. If that happened today, with gold at $2,650, silver would be trading at $85 an ounce. Now, I'm not saying that's going to happen tomorrow, but I am saying that the current ratio suggests silver has significant upside potential. And when you combine that with the supply squeeze we're seeing, the industrial demand surge, the geopolitical uncertainty, and the COMEX inventory decline, you start to see why smart money is accumulating physical silver right now. Quick aside here. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description below. It covers how to get physical precious metals into your retirement account without triggering tax penalties. Worth checking out if that's relevant to your situation. Anyway, back to what's happening with these back orders. Here's what I think a lot of people don't understand about the precious metals market. It's not like stocks. You can't just click a button and instantly own silver. There's a physical supply chain involved. Silver has to be mined. That takes years of exploration, permitting, and development. Then it has to be refined. Then it has to be minted into coins or bars. Then it has to be distributed to dealers. Then it has to be shipped to you. Every step in that chain has constraints, and right now, multiple steps are bottlenecked. Mining production is flat. The big silver mines in Mexico, Peru, and China aren't expanding. In fact, some are declining, because silver is often a byproduct of other mining operations: copper, zinc, lead. Silver production is tied to those industries, and those industries aren't booming right now. Refining capacity is limited. There are only so many refineries that can process silver to the purity standards required for investment-grade products. Minting capacity is maxed out. The U.S. Mint is running at full capacity. Private mints are running at full capacity, and they still can't keep up with demand. This is why the backorders matter. It's not just a temporary blip. It's a structural issue. And here's the thing that really concerns me. Most of the silver being bought right now isn't being sold back. It's going into strong hands. People who are buying for long-term wealth preservation, not short-term trading. When silver goes into strong hands, it comes off the market. It's not available for the next buyer, which means the supply squeeze gets tighter. I've talked to dealers who tell me they're seeing a different type of buyer now compared to previous years. It's not just the usual precious metals enthusiasts. It's retirees worried about their savings. It's young professionals hedging against inflation. It's small business owners diversifying their assets. The buyer base is broadening. And that's a sign that awareness is spreading. Now let me tell you about what happened in 1980. This is important because it's the only time in modern history when silver truly went parabolic. In 1979, silver was trading around $6 an ounce. The Hunt brothers, a wealthy Texas family, started accumulating massive amounts of physical silver. They believed inflation was going to destroy the dollar, and they wanted a hard asset hedge. By January 1980, silver hit $50 an ounce, an 8 times increase in less than a year. Now, the Hunt brothers' story ended badly. They were accused of trying to corner the market, and regulators changed the rules to stop them. The price crashed back down. But here's what's interesting. The conditions that drove silver to $50 in 1980 are similar to what we're seeing today. High inflation, currency debasement, geopolitical instability, loss of confidence in government institutions. The difference is, back then it was a few wealthy individuals driving the price. Today, it's millions of retail investors worldwide, all making independent decisions to buy physical silver. You can't regulate that. You can't stop that. And that's why I think this cycle could be even bigger than 1980. Let me show you another data point that's flying under the radar. Silver ETFs, exchange-traded funds that hold physical silver, have been seeing outflows. The big ones like SLV have seen their holdings decline, and on the surface that looks bearish. It looks like investors are selling silver. But here's what's actually happening. Investors are pulling silver out of ETFs and buying physical. Because they don't trust the ETF structure. They want metal they can hold. When you own shares of SLV, you own a claim on silver held in a vault somewhere. But you can't take delivery. You can't hold it. And if there's ever a crisis, you're just a paper claimant in line with everyone else. Physical silver in your possession? That's different. That's real ownership. So the ETF outflows aren't bearish. They're actually bullish, because that silver is moving from weak hands to strong hands, from paper to physical. And every ounce that moves from an ETF to a private vault is one less ounce available for the next buyer. Here's another thing to consider. The role of China. China is the world's largest silver producer. They mine about 3,600 tons of silver per year, but they're also becoming one of the largest consumers. Their solar panel industry alone is consuming massive amounts of silver. And here's the kicker. China has started restricting silver exports, not officially, not with tariffs or quotas, but through administrative delays, permitting issues, and other bureaucratic measures. Why would they do that? Because they need the silver domestically, and because they understand that silver is a strategic resource. If China continues to restrict exports, that removes a significant source of supply from the global market, which makes the squeeze even tighter. Now I want to address something I hear a lot. But the price isn't moving. If there's really a shortage, why isn't silver at $50 or $100? Great question. And the answer is paper market suppression. Look, I'm not a conspiracy theorist, but the data is clear. Large banks hold massive short positions in silver futures. They profit when the price goes down or stays flat, and they have the capital to manipulate the paper market in the short term. But here's the thing about manipulation. It only works until it doesn't. You can suppress the paper price, but you can't create physical metal out of thin air. And when the physical market diverges far enough from the paper market breaks. We saw this with nickel in 2022. The London Metal Exchange had to halt trading because the price spiked so dramatically that it threatened to bankrupt major players. The paper market couldn't handle the physical reality. The same thing could happen with silver, and when it does, the price won't move gradually. It'll gap up overnight. That's why these back orders matter. They're a sign that the physical market is already diverging from the paper market. Let me give you a practical example of what this means for you. Let's say you decide you want to buy 100 ounces of silver. You go to a dealer's website. You see Silver Eagles listed at $35 an ounce. That's a $4 premium over the spot price of $31. But when you try to order, you see 3-month back order. So you have two choices. You can pay $35 an ounce and wait 3 months. Or you can pay a higher premium for immediate delivery from a different product. Most people will wait. They'll think, I'll save money by waiting. But what happens in those 3 months? If the spot price goes to $40, you're still paying $35 plus the premium, so maybe $44. You saved $9 per ounce by waiting. But what if the spot price goes to $50 or $60? Now you're wishing you'd paid the higher premium for immediate delivery. This is the gamble people are taking right now. And it's a gamble most don't even realize they're making. Here's what I'm seeing from dealers. Premiums are rising even on back-ordered products. 2 months ago, Silver Eagles were $3 over spot. Now they're $4 over spot, even with a 3-month wait. That tells you demand is still accelerating. People are willing to pay more and wait longer just to secure their position in line. And that's classic squeeze behavior. Now, let's talk about what happens when the back orders clear. There are 2 scenarios. Scenario 1, demand moderates. The mint catches up. Premiums come down. Life goes back to normal. Scenario 2, demand continues to accelerate. The mint clears the backlog, but new orders immediately create a new backlog. Premiums keep rising. The spot price starts to catch up to the physical premium. And we enter a feedback loop, where rising prices create more demand, which creates more shortages, which creates higher prices. Which scenario is more likely? Based on everything I'm seeing, the industrial demand trends, the geopolitical situation, the monetary policy environment, the COMEX inventory decline, I think scenario 2 is far more likely. Because here's the thing, the fundamentals driving silver demand aren't going away. Solar panel installations are projected to double by 2030. Electric vehicle production is ramping up. 5G infrastructure is still being built out. These are multi-year trends that require massive amounts of silver. On the monetary side, central banks are still buying gold, which drives retail into silver. Inflation is still elevated, even if it's come down from the peak. The US debt is still growing at an unsustainable pace. And geopolitically, the world is becoming more fragmented. The dollar's dominance is being challenged. BRICS nations are exploring alternative currencies. Trust in institutions is declining. All of these factors support precious metals demand. And silver, as the more affordable option, captures a disproportionate share of that demand. So when I see a 3-month back order on Silver Eagles, I don't see a temporary inconvenience. I see the early stages of a major supply squeeze. And history shows us what happens during supply squeezes. Prices don't move in a straight line. They move in steps. Periods of consolidation followed by sharp spikes. We saw this in 2020. Silver was at $12 in March. By August, it was at $29, a 140% move in 5 months. We saw it in 2010 to 2011. Silver went from $17 to $49 in less than a year. Could we see it again? Absolutely. And the back orders are the canary in the coal mine. Here's another angle to consider: the role of sovereign wealth funds and family offices. These are the ultra-wealthy individuals and institutions that manage billions of dollars, and they're starting to allocate to physical precious metals in a way they haven't in decades. I've seen reports of family offices buying silver by the ton, not by the ounce, by the ton. Why? Because they see the same trends I'm describing. They see the supply constraints. They see the demand drivers. And they're positioning ahead of the crowd. When institutions start buying physical silver, it removes massive amounts from the available supply. And it signals to other institutions that this is a legitimate asset class worth allocating to. That creates a cascade effect. More institutions buy. More supply comes off the market. Prices rise. More institutions take notice. The cycle continues. We're in the early stages of that cycle right now. Now, I want to address the skeptics. Because I know there are people who will say, silver has been a terrible investment. It's still below its 1980 high. Why would I buy now? Fair point. But let's add some context. In 1980, silver hit $50 in a speculative bubble driven by 2 individuals trying to corner the market. That wasn't a sustainable price based on fundamentals. Today, silver at $31 is supported by genuine industrial demand, investment demand, and supply constraints. It's a fundamentally different situation. Also, if you adjust the 1980 high for inflation, it's equivalent to about $185 in today's dollars. So silver would need to 6x from here just to match its inflation-adjusted all-time high. That's not a ceiling. That's a target. And when you look at the supply-demand fundamentals, a 6x move isn't crazy. It's actually quite reasonable over a multi-year time frame. Let me give you one more piece of the puzzle. The energy transition. Governments worldwide are pushing for renewable energy. Solar, wind, electric vehicles, battery storage. All of this requires massive amounts of silver. The International Energy Agency estimates that the energy transition will require 90% more silver by 2040 than current production levels. 90% more. Where is that silver going to come from? Mine production is flat. Recycling can only provide so much. Above-ground stockpiles are depleting. The only way to balance supply and demand is through price. Silver needs to go high enough to incentivize new mine development, increase recycling rates, and ration demand. How high is high enough? Nobody knows for sure, but it's certainly higher than $31. And that's why these back orders matter. They're telling you that at current prices, demand exceeds supply. The market is out of balance, and the only way to restore balance is through higher prices. So when you see a 3-month back order on Silver Eagles, don't think of it as an inconvenience. Think of it as information. The market is telling you something important. It's telling you that physical silver is scarce. It's telling you that demand is strong. It's telling you that the people who understand this market are buying aggressively. And it's giving you a choice. You can wait. You can hope the back orders clear and prices stay flat. You can hope that demand moderates and supply catches up. Or you can recognize that back orders are a symptom of a deeper imbalance, an imbalance that's likely to get worse before it gets better. The smart money isn't waiting. They're paying the premium. They're getting in line. They're securing their position now, before the crowd realizes what's happening. Because once the crowd realizes, it'll be too late. Premiums will be double what they are now. Back orders will be 6 months instead of 3. And the spot price will have already made its move. This is how markets work. The information is available to everyone, but only a small percentage act on it early. The 3-month back order on Silver Eagles isn't a secret. It's public information. Anyone can see it, but most people will ignore it. They'll rationalize it away. They'll convince themselves it doesn't matter. And 6 months from now, when silver is at $45 or $50 or higher, they'll wonder why they didn't act when the signs were so clear. Don't be that person. The back order is the warning. The question is, are you listening?